Welcome back. You're tuned into Editors Roundtable. Well, Diagnostic stocks, they're close to the 52-week highs after the stellar rally we've seen from 52-week lows. What's aiding this upswing, Ekta? Tell us.
Well, yes, it seems as though the interest is now coming back into the entire diagnostic space. If you look at it, there's been a significant rally from the 52-week lows. For example, Dr. Lars Metropolis up anywhere between 40 to over 50-odd%. There is a lot of optimism now coming into these incumbent players, and the reason for that is basically the fear of steep price wars has eased from online diagnostic companies. For example, online aggregators are now saying that there is stabilization of pricing in routine tests, for example, thyroid, CBC, all of those tests. In fact, prices have risen 20 to 25% from lows seen in routine tests. Remember, there was steep discounting which was taking place at one point in time. The agenda now seems to be shifting to sustainable growth versus rapid testing growth. Now, what is helping the incumbents, such as, say, the likes of Dr. Lals, Metropolis, all of these? Realization that demand is inelastic. There is more focus on trust and quality names when it comes to testing. Overhang of margin dilution is now over because that's eased due to price competition easing. For example, Dr. Lal margins in FY24 were 27%, Metropolis 23.4%, Thyrocare 24%. Now, factors aiding margins is that the incumbents have managed to, in fact, raise prices in the past 1 to 2 years. There are higher margin packages also, such as, say, preventive testing, bundle testing. There's one person who comes to your house, takes your blood, and you do many tests with that particular sample. Your fixed costs are low, but the amount of revenue you're generating from that one test is higher. So that works. Now, for example, Dr. Lal's FY24 Swasthfit sales were up 32%, and Metropolis, their wellness packages were up around 23%. So there seems to be this narrative shifting. But Gautam, I just wanted to come to you on that, because before we went into the break, you mentioned that hospitals is a theme which is not fully played out. Do you think that there's a preference on diagnostics over hospitals simply because there's this overhang about standardization of rates from the Supreme Court, which could probably stem that kind of interest in hospitals?
No, I think I would differ there because, see, diagnostics, while it's a good theme, there will always be a sword hanging on the margins because the competition is very intense. Whereas hospitals is a very capex intensive business, right? And not everyone can come and succeed here and can make a 20-25% kind of an EBITDA margin. So you need a brand, you need execution, which I think both Max, Medanta, all of them have demonstrated over the last 3 years. I think they've been breaking even in cities like Patna, Lucknow within 12 months, 18 months. Now, what happens to this whole pricing thing is, I think they will have to smoke a peace pipe with the regulator courts and see how both sides can come to a solution, because you do need branded healthcare in this country. In post-COVID, the awareness of branded healthcare has gone up. So hospital has no longer remain a purely discretionary expense, right? Because people have started valuing it, right? Earlier, this was not the case pre-COVID. Hospital, you always used to wonder what is the cost here and what is the cost there. Today, I think that element of discretion is slowly shrinking away, which is why I feel the room for expansion in terms of the network, I don't know what is the right word, but the number of cities which can absorb some of these branded hospitals is still high. And we are just about starting that journey. So I think the multiples in hospitals can sustain for far longer time than, say, in diagnostics. Because diagnostic, at the first sign of new competition emerging, the multiples can derate again.
Okay. I have one last question for you, and this is a stock-specific one. I think the Trent, you've always been ahead of the street on this one, and all your targets were met. This week also we saw a big breakout in the stock. What's happening here, and are you aggressively reworking your targets here?
No, so Anuj, in such cases, you have to take a very simplistic view. You just look at the growth and then look at the growth differential versus the peers in the same companies. So last 2-3 quarters, Trent has been growing top line at 40-50%, right? 40-50% top line growth when the peers in the same sector are struggling to grow at 15-20%. Second, they've got their execution exactly correct, whether it is Westside, whether it is Zudio, whether it is other elements of their businesses. So their margins have also expanded. The profit growth is 200-300%. So to be honest with you, at 2000 also I felt stock is very expensive.
Yeah.
We just wanted to wait before we take that call on valuations. We wanted them to disappoint on earnings before I take a call on valuation. But the earnings kept surprising every quarter for last 3-4 quarters. So we stood there and waited for earnings to disappoint. They've not disappointed yet, which is why stock price is in a very different zone. So while it's a value retailer, but valuations are not showing any value right now.
Okay, all right. On that note, Gautam, we're going to wrap up. Thanks very much for joining in, and everybody enjoy that long weekend which is in store. We're going to be back on Tuesday with all of the market news and updates. Thanks for watching.